Inflation risks are rebuilding at the same time as AI-driven equities push back toward the highs, leaving allocators to question how long bonds, credit, and the dollar can quietly absorb the strain. Welcome to vTalkInsight, Allocator's Lens Daily for July 10th, 2026. Let's start with what this evolving backdrop means for global equities. In equities, the standout feature is how quickly risk appetite has returned even as the policy backdrop has turned more hawkish. The S&P 500 just logged a solid daily gain with volatility still anchored in the mid-teens, and technology and semiconductor names are again leading the move. That resilience signals that many investors remain comfortable paying for growth, especially for companies linked to artificial intelligence and data centers, despite higher yields and louder inflation risks. Under the surface, though, this is an AI-dominated tape with increasingly asymmetric risk. Equity allocations for U.S. households and mutual funds are around record levels, which means the shock absorption capacity on the downside is limited if something breaks. The AI complex itself shows several late-cycle hallmarks. There is heavy leverage, large capital raising, and very ambitious earnings assumptions, with forecasts for strong double-digit profit growth sitting alongside signs that data center revenue growth has already slowed into the mid-teens. Set against that, there are credible structural winners emerging, particularly in the supply chain. Demand for compute is outrunning today's capacity. Semiconductor and infrastructure providers enjoy high intellectual property barriers, and the memory industry has consolidated into a small group of global firms with genuine pricing power. The recent reception for a large South Korean memory listing in the United States, which was many times oversubscribed despite earlier weakness in Korean tech, underlines how strong the appetite still is for levered AI plays when valuation and growth stories line up. Leadership is also rotating beyond megacap hardware. Cyclical sectors in Europe, selected healthcare names, defense stocks linked to higher NATO, spending, and Latin American equities are all participating, often from more modest valuation starting points than the flagship AI beneficiaries. The main equity risk from here is macro. If oil and other cost shocks push inflation high enough that the Federal Reserve and the European Central Bank feel compelled to deliver more than a single additional hike, the combination of elevated valuations, record positioning, and very heavy AI capex could leave earnings and multiples exposed. Upcoming results seasons, capex guidance, and any sustained rise in long-dated yields are therefore crucial equity watch points. Turning to rates, the core message from the latest Federal Reserve communications is a reaction function that is both unified and more hawkish. Minutes show broad agreement that if inflation stays above target, the committee is prepared to raise rates again, regardless of whether the pressure comes from energy, tariffs, or the AI investment boom. Markets have swung from debating rate cuts to assigning a meaningful probability to at least one more hike, and in some cases even two, while pricing out the prospect of easing this year. Beyond the front end, several forces are pushing term premia higher. Persistent inflation concerns, rising sovereign debt issuance, and heavy corporate supply linked to data center and AI infrastructure are all putting upward pressure on long-term yields in the United States and in Europe. German 10-year yields have risen for multiple sessions in a row, supported by higher oil prices and a rebuilding term premium, while Euro area data already show manufacturing weakness, raising the risk that the European Central Bank is tightening into a soft patch. There is still solid demand for income at today's levels. Recent U.S. Treasury auctions have cleared smoothly even at the highest yields since earlier in the year, and investor interest remains firm in medium-duration paper that offers attractive coupons without the full interest rate sensitivity of the long end. Corporate bond markets echo that balance. 30-year investment-grade yields approaching 6% draw interest, but the sheer volume of new issuance around AI and infrastructure is forcing investors to rethink what really counts as compelling compensation for duration risk. A key cross-asset implication is that bonds are becoming a less reliable hedge for equities. Supply shocks and large government and corporate financing needs mean that yields can rise at the same time as risk assets struggle, undermining the traditional negative correlation multi-asset portfolios rely on. For allocators, the rate market now revolves around two uncertainties: whether a single additional hike is enough to restore inflation credibility, and how far long-term yields can climb before they start to bite into real economic activity and the AI capex cycle. Energy prices and forthcoming inflation prints will be decisive for that path. In credit, capital markets remain open, but the balance of power has shifted subtly toward investors. Large technology and infrastructure issuers are tapping debt markets to finance massive AI and data center programs, and recent deals have needed to offer higher concessions to clear, as seen in high-profile investment-grade transactions. That tells you that buyers still want exposure, but they are demanding more compensation for taking duration and concentration risk in these themes. High yield remains a focal point. Yield around 7%, with roughly one-third the volatility of equities, are viewed as an appealing source of carry, especially as many issuers sit in the double B and single B part of the spectrum, where structural improvements point to lower default rates than in past cycles. Appetite for AI-related credit is particularly strong, and spreads are unlikely to widen meaningfully unless broader stress forces a systemic repricing. At the same time, we are seeing more idiosyncratic stress and regional differentiation. Distressed situations, such as a well-known UK automaker now, in complex talks with secured bondholders highlight that weaker balance sheets are being tested by higher financing costs. Some managers are also diversifying away from crowded U.S. high yield into European and emerging market credit. For allocators, the key signals are new issue concessions, migration in default expectations, and how far credit can continue to fund the AI build-out if central banks are forced to lean more hawkish. On the currency side, the dollar's narrative has shifted back in its favor. Stronger U.S. data and higher front-end yields, combined with the move from expected cuts to potential hikes, have reinforced the dollar's support from elevated real interest rates. Positioning has swung to a sizable net long, yet the broad dollar index has not revisited prior peaks, leaving room for further upside if current rate dynamics persist. Policy divergence is most visible against the yen. The Bank of Japan remains reluctant to raise rates meaningfully despite persistent currency weakness and ongoing capital outflows, and many market participants expect any official intervention to be met with renewed selling pressure. That skepticism keeps the yen vulnerable as long as U.S. and European yields stay elevated and Japanese policy remains anchored near the lower bound. Elsewhere in Asia, currency moves are increasingly driven by capital flows linked to equity events rather than domestic fundamentals. The Korean won has lagged even as the local equity index and a flagship chipmakers overseas listing drew strong foreign demand, prompting the central bank to frame recent weakness as temporary. For allocators, the broader message is clear. A firmer dollar tightens global financial conditions, tests emerging market FX, and can amplify the impact of any future risk-off episode triggered by rates or commodities, even if day-to-day moves are dominated by local stories. Commodities sit at the heart of today's macro tension, with energy leading the story. Escalating frictions between the United States and Iran have slowed shipping through the Strait of Hormuz to a crawl, pushed insurance premia sharply higher, and raised the risk of further disruptions to oil and refined product flows. Yet crude prices have recently eased back, suggesting markets either expect alternative routes to keep supply flowing or are assigning more weight to potential demand headwinds than to an immediate supply shock. Natural gas and liquefied natural gas markets look more fragile. A pause in Qatari expansion plans following tanker attacks, together with ongoing instability around key shipping lanes, is injecting fresh uncertainty into global supply. Europe is unlikely to rebuild gas inventories to the comfort levels seen before recent crises, and several Southeast Asian economies remain heavily reliant on Qatari cargoes with limited alternative routes, leaving them exposed if tensions persist into winter. Agricultural commodities add another layer of risk. Weather disruptions and a possible super El Niño are already affecting key crops, with heavy rains in Brazil damaging coffee output and excessive rainfall helping drive cocoa prices from roughly $4,000 to around $6,000 a ton. At the same time, disruptions to fertilizer exports and structurally higher input costs point to a higher floor for global food prices. For inflation-focused central banks, this mix of energy and food pressures is difficult to ignore and could be the catalyst that tips the policy debate toward renewed tightening. Pulling it all together, the cross-asset picture is one where an AI-driven equity boom, still eager credit markets, and a firm dollar are running up against a more hawkish central bank backdrop and renewed energy and food shocks. Equities offer powerful growth narratives, but from stretched positioning and ambitious earnings assumptions. Rates are repricing toward a higher for longer regime, eroding the traditional hedge value of long-duration bonds. Credit continues to finance the capex cycle, though investors are demanding better compensation, while currencies and commodities translate policy divergence and geopolitics into tighter global financial conditions. For allocators, the key watch points now are upcoming inflation data, the behavior of long-term yields, credit issuance terms, the path of the dollar and yen, and any escalation around key energy choke points. How those pieces evolve will determine whether today's uneasy coexistence of buoyant risk assets and rising macro risk can persist. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.